Hey, Andy, what a week. Getting ready for back to school. School supplies have been bought. Haircuts are done. Tell me about the market. What's going on?
The mortgage market is improved in the last 48, 72 hours. We got some late economic news late last week that not only was the new jobs report, new jobs created, a little bit lower than expected, but there was a revision on May and June's report. And there's a little bit of political entertainment around this. President Trump decided to fire the person that's in charge of these reports. He feels like they could be politically swayed. Regardless of whether that's true or not, the reports were revised to show less jobs have been created in the last 90 days than expected. And that caused interest rates in the U.S. economy to start dropping on Friday. We saw about a quarter point improvement in interest rates with like the 10-year Treasury, which mortgage rates are kind of following along as well. They don't exactly follow, but we're quoting lower mortgage rates today than we were last week.
That's awesome. And it's definitely a long-awaited desire to see rates go down. And I know every week we talk, it's up, it's down, it's up, it's down. As a consumer, there's so much information at our fingertips when we go to the internet. What are types of things that you kind of recommend people steer clear of, be careful about? What would you look at if you were just trying to get a general idea of where rates are?
Very good question. So first off, the internet is a great place to go and kind of get a little bit of an understanding of where are mortgage interest rates today. But not all mortgage interest rates are the same. It's complicated. Okay, so we're looking at a lender's interest rate website. Most lenders, when you go to their website, they'll have a icon you click on and say today's rates or purchase rates or refinance rates. I've done this on one particular website, and I've tried to block the website out because I don't want to call another company out. But here on this website, you can see they have, first off, up here on this part of the screen, different types of mortgages that you can click on to get interest rates, purchase, refinance, VA loans, et cetera. We'll come back to that in a minute. The first question you should ask yourself is, why would I have to click on something different for a purchase than I would in a refinance? Because rates are different for those two types of transactions. But we're just clicked on the purchase transactions, and there's a long list of programs here. I just have you seeing the first two, a 30-year fixed rate mortgage and a 30-year fixed FHA mortgage. These are two different types of mortgages. Rates are in green. They're pretty easy to read. So if I looked at this website and I didn't know much about mortgages, I'd think, oh, rates are right around 6.25%. Or if I can do an FHA loan, whatever that means, I could get a rate of 5.875%. And there's APRs with those. And APRs are intended to include all of the costs with the mortgage, not just the interest rate. So when you go to closing, you have title charges, appraisal charges, other charges that they then put into a factor of what's an annual percentage rate. Here's where I really want to take your attention. There's two on each one of these rows. There's something called points. Points are additional costs on mortgages to obtain a lower interest rate. So here you see on the very first row, a 30-year fixed rate mortgage with a 6.25% interest rate, APR 6.449 with 2.07 points. And in parentheses, it's got a cost of $3,306. So first off, a point in terms of a mortgage is 1% of the loan amount. So if I had a $100,000 loan, I would have a $1,000 1 point if the point was 1 point. In this particular case, they have 2.07 points costing $3,306. What that tells me is this is an interest rate quote for $159,710 loan amount. So take that into consideration. Points are not necessary. They can be advantageous for home buyers or anybody looking to obtain a new mortgage, but you need to evaluate that. And what you don't want to do is look at a website like this and go, oh, they got a great rate. They're beating the rate I see on everybody else's website, so I should go with them. You got to be careful because they have points on this interest rate. The other thing I want to call out is I talked about it before. The purchase page on that website could have a different interest rate than the refinance page. There are different factors, and we call them loan level price adjusters, that adjust interest rates or cost of an interest rate up or down, depending on the very specific transaction each person is doing. And this is just another screenshot I took from that website of factors that affect your current mortgage rate. Every website that has interest rates included on it has, some type of disclaimer saying this is based on this loan amount, this is based on having this credit score, this is based on this, yada, yada, yada. So let's talk a little bit about loan level price adjusters. What are all the different loan level price adjusters that could cause my interest rate to be different from yours, Andrea, different from somebody else's. So a few of them are credit score, loan to value, occupancy type. So whether you're going to live in the home or you're going to buy it as an investment property and rent it out to other people, or maybe it's going to be your vacation home. Those three different types of occupancies can result in a different interest rate. Loan purpose, are you buying the home, or are you refinancing a home, or are you thinking about taking equity out of your home, which we call a cash out refinance transaction? The property type can change the interest rate. We will have a different interest rate for, let's say, a condominium as opposed to a single family detached home or a manufactured home. The different types of property will drive the type of loan level price adjustment that might be applied to it, both up or down. The loan type, a 30-year fixed rate mortgage has a different interest rate than a 15-year fixed rate mortgage or even a 10-year fixed rate mortgage. The size of the loan can have loan level price adjusters. And actually there's loan level price adjusters up if the loan sizes are small now, and there's loan adjuster sizes down as the loan increases, and then eventually gets to the point where there's adjusters back up again. First-time home buyers have adjustments to these loan level price adjusters. There's some of these adjustments like loan to value or even credit score that are waived for first-time home buyers. So if you're a first-time home buyer, you want to make sure that if you're speaking with a loan officer, they're factoring in that you're a first-time home buyer in their pricing. Subordinate financing can also play a role, meaning is there another loan on the home that you're looking to finance? Typically, this comes across more on refinances than purchases. Maybe you've taken out a home equity line of credit, but you only want to refinance your first mortgage and you want to keep that line of credit in place. That line of credit could potentially have impact on the interest rate that you're going to get on the refinance of your first mortgage. Mortgage insurance and coverage and energy efficiency have some small loan level price adjusters as well.
That's actually really interesting information, Andy. I don't think most people realize that much goes into what an interest rate is when they're looking at it. And when you are shopping in the internet, there are so many different types of hypotheticals that are put into place with what you're seeing. If you don't mind, though, let's go back and talk about that points topic a little bit more. How do I know whether or not it makes sense to pay points, and really why would anybody pay them?
Yeah, great question, Andrea. So again, let's just define what a point is. When you hear about points on a mortgage, 1 point equals 1% of the loan amount. So if a loan is $100,000, 1 point would be $1,000, 1% of the $100,000. What you're looking at here is what I call a rate stack, an interest rate stack. Just about every lender has these. This is ours to a particular loan scenario. Like I said, all the LLPAs have determined this rate stack for me, whether it's a primary home. This is a purchase transaction. This is a primary home. This is a $400,000 loan amount, putting 20% down with a 740 credit score. And this is not an offer of financing to anybody watching this. That's why we're not providing APRs in this scenario. So first off, I'm going to point out in this rate, every single row represents an interest rate a client could come to us today and lock in if they wanted to for a 30-year fixed rate mortgage. What's different for all these interest rates is not just the interest rates moving up and down. It's the monthly payment and the points associated with the interest rate. So let's just look at the one where the arrow is pointed. It's a 6.49% interest rate. It has 1.126% in point, which 1.126% of a $400,000 loan represents $4,506 in cost to get the rate of 6.49. And the payment is $2,526 a month of principal and interest. Let's compare this to another option here I have highlighted in blue. This option is 6.875%, so it's a higher interest rate, but it has lower upfront costs. It only has 112 in points that have to be paid up front. The payment's going to be higher because the payment is $2,628. The rate's higher, so the payment's going to be higher. But you're only spending $112 as opposed to $4,506 upfront in points. So how do you know which one is a better option for you? And the best way to measure that is a break-even analysis. A break-even analysis is going to say, if I'm going to save, in this particular case, I'm saving $102 a month. I'm saving $102 a month in this scenario, but it's going to cost me a little bit more than $4,300 to save $102 a month. So a break-even a calculation is, what is the difference in costs divided by the difference in interest rate? And when I do this in this scenario, the difference in cost between these interest rates is $4,394, and the difference in the payment is $102 a month. Therefore, my break even is 43 months. If you wanted to put that into an annual calculation, you just divide that by 12, and it basically tell you it's going to take you about 3 years and 3.5 years to break even. What that means is in 3.5 years in this particular case, the amount I save on my monthly payment for the lower interest rate equals the amount I paid for the difference in that interest rate up front. So the $102 equals the $4,394 in about 3.5 years. So I have saved no money in 3.5 years in this particular scenario. If I took the lower interest rate, I will start saving a net $102 a month every month if I took the higher points. What's important to the break even, the real question you ask yourself is, do I think I'm going to have this mortgage for as long as the break even exists? Do I think I'm going to stay in this home and I'm going to utilize this mortgage for more than 3.5 years? And you want it to be substantially more, right? The goal isn't just to break even on costs up front. The goal is to really save money. So if I think this is going to be my forever home, I really don't see myself moving in, 5 years or 10 years or 20 years, there's no anticipation of that, I might want to consider paying these points. If I'm not sure, or this is the first time I'm buying a house, pretty good chance I could get a promotion in the next couple of years. I might want to move to a different area, or I might want, maybe I'm going to have kids in the next few years. That's the plan. I'm about to get married. I might need a bigger house. There's no way I'm paying that point up front for the lower interest rate. The lower interest rate might be appealing because it looks lower, the payment's better, but I'll never recoup that $4,400 it's going to cost me for that interest rate. Let me flip this into a different conversation for real estate agents. In this particular case, seller concessions have become a really important topic in the market today. So if there is a seller that is, had their home on the market for a little while and it's not getting the traction that you want or they want, this is where you could really appeal to home buyers and say, you know what, I'm not going to drop the price of the home that I'm trying to sell. Maybe what I'll do in this particular scenario is maybe I'll offer a 1% seller concession. So that somebody buys my house with this profile could get a 6.49% interest rate. Maybe I'll offer a 2% seller concession. And if you take your eyes back up this screen, I could potentially, if I offer a buyer 2% seller concession, that buyer could put that 2% towards buying the rate down to 6.25%. I could even go so far to say, maybe I'll offer a 3% concession, and I could market my house today that if you bought my house specifically, you're potentially going to get a rate of 6% or better.
Love it. That was awesome detail and insight, Andy. And, I think that also is a good reminder for people to not just look at what's shiny. And I know we talk a lot about it's not just the interest rate, really. And tell me what I should look for more than just my interest rate.
Well, so everything lines up, right? Are you living in the right home, or are you about to buy the right home? Is it the right location, is the right place for you? But when it comes to financing, interest rates are a really, really important part of evaluating which mortgage you should go with and who should do your mortgage. But on top of that, the cost of the interest rate, the overall cost of the mortgage. A lot of lenders have additional fees in their cost, maybe a processing fee or an underwriting fee or an admin fee. You want to look at your loan estimate, either a closing cost disclosure or a loan estimate from a lender. And you want to work with a loan officer that is patient, that takes you through this information, gives you options, and educates you on the rate stack, the break-even analysis on these interest rates. And you also want to work with a lender that can execute, right? Like, not every mortgage is the same when it comes to, the documents we need from clients and the analysis that's going to be done by an underwriter. You want somebody that's got good reviews online. They've done a really good job. They've been referred to you either by your agent or by somebody else. You feel confident with how they speak with you, and you are getting educated by somebody that's taking their time and they're patient with you and they're giving you all their options.
That's awesome, Andy. And I think it's great too for agents to know when their customer comes to us and says, what's today's rate? It's not that we're hiding anything by not directly answering that question, but there's a lot more questions that we want to ask for being able to give that information. It's like putting info to the top of a funnel, and we'll give you the interest rate and the payment at the end. But we're going to ask some questions first just to make sure we're doing the right thing for that customer.
The sign of a great loan officer is they ask a lot of questions.
Thank you again, Andy, for all the amazing insight. We will see everybody next week. Please don't forget to like, to share, and to follow us for all of our future information. See everyone next week.